Effective position management is not merely a tactic, but the cornerstone of sustained success in the volatile world of trading, serving as the critical bridge between theoretical market analysis and tangible profit realization. It is the disciplined art of controlling trade size, managing risk, and optimizing returns throughout the life cycle of an investment, distinguishing consistently profitable traders from those who merely gamble. Understanding and implementing robust position management strategies is paramount for minimizing potential losses while simultaneously maximizing the upside potential of winning trades. Among the legendary figures whose insights continue to illuminate the path for modern traders, Jesse Livermore stands preeminent. His unparalleled success in the early 20th century markets largely attributable to a profound and meticulously applied strategy for managing his positions. This strategy, honed through decades of market engagement and countless triumphs and setbacks, provided him with the framework to navigate speculative markets with extraordinary precision, ultimately allowing him to amass and protect vast fortunes. This video delves into the core tenets of Livermore's position management approach, revealing the timeless principles that enabled him to make millions and continue to offer invaluable lessons for traders today. At the heart of Jesse Livermore's legendary trading prowess lay a set of fundamental principles for position management, distinctively characterized by a methodical, almost scientific approach to market engagement. The most iconic of these is his concept of pyramiding, a strategy centered around the gradual opening of a position. Livermore understood that the market rarely reveals its true direction definitively from the outset. Instead of committing a large sum to a single entry point, he advocated for starting with a small, manageable test position. This initial foray into the market served a crucial purpose: to gauge the market's immediate reaction and confirm the nascent trend. Only when the market unequivocally moved in the anticipated direction, thereby validating his initial hypothesis, would Livermore consider adding to his position. This incremental approach was not merely about reducing initial risk. It was a sophisticated method of letting the market itself confirm the validity of his trade idea before increasing exposure. He would add to his position in stages, but critically, each subsequent addition would be smaller than the last. This pyramid structure ensured that his largest commitment was to the earliest, most confirmed part of the trend, and as the position grew, the average entry price would remain favorable, while the risk associated with later, potentially less certain additions was proportionally smaller. This disciplined accumulation prevented him from overcommitting capital prematurely and ensured that his position grew in strength only as the market confirmed its direction, allowing him to build substantial exposure in strongly trending assets without undue initial risk. Complementing his pyramiding strategy was an unwavering commitment to managing losses and safeguarding capital, a principle Livermore considered absolutely sacrosanct. He famously declared that the cardinal sin in speculation was to let a loss run. His approach was brutally simple yet profoundly effective: strict adherence to stop losses. Before entering any trade, Livermore meticulously determined his maximum acceptable loss, placing a stop-loss order that would automatically close the position if the market moved against him beyond that predetermined point. This was not a suggestion, but an ironclad rule, executed without hesitation or emotional attachment. He understood that small losses are an unavoidable cost of doing business in the markets, but large, uncontrolled losses are catastrophic. The priority was always the preservation of capital, viewing it as the indispensable tool of his trade. He recognized that without capital one cannot trade, and therefore protecting it was paramount to long-term survival and success. Livermore's swift closure of losing positions, devoid of emotional bias or the hope for a reversal, stands as a stark contrast to the common amateur mistake of averaging down on a losing trade, a practice he vehemently condemned. For Livermore, a loss was a clear signal that his initial assessment was incorrect, and prolonging it only amplified the error. This disciplined approach to cutting losses ensured that his capital was always available for the next, potentially profitable opportunity, rather than being tied up in or decimated by failing ventures. While rigorously controlling losses, Livermore was equally emphatic about maximizing profits, articulating the enduring wisdom to let profits run. He understood that the truly substantial gains in trading do not come from a multitude of small wins, but from holding on to a few large winners for the duration of a significant market move. Many traders fall prey to the temptation of taking small profits too early, fearing a reversal and missing out on guaranteed gains. Livermore, however, possessed the patience and conviction to allow his profitable positions to develop fully, riding strong trends until there were clear, objective signals of their exhaustion or reversal. He was keenly aware that premature profit-taking severely limits the upside potential, effectively putting a ceiling on one's returns and hindering the ability of winning trades to offset the inevitable small losses. His strategy involved identifying target levels based on market analysis, but also using dynamic exit strategies, such as trailing stops, to protect accumulated profits while still participating in further upside. This approach required a deep understanding of market cycles and the ability to distinguish between temporary pullbacks within a trend and genuine trend reversals. By allowing his profitable positions to mature, Livermore ensured that his winning trades were truly impactful, providing the leverage necessary to achieve multi-million-dollar fortunes. Underpinning all of Livermore's technical and tactical principles was an unshakable psychological fortitude and unwavering discipline. He stressed the paramount importance of patience, urging traders to wait for clear, unambiguous market signals before acting. He believed that the biggest profits were made not by constantly being in the market, but by waiting for the opportune moments when the odds were overwhelmingly in one's favor. This often meant long periods of inactivity, observing and analyzing rather than impulsively trading. His success was not built on constant activity but on strategic inaction, followed by decisive, well-timed moves. Furthermore, Livermore's discipline extended to strictly adhering to his own trading system and avoiding emotional decisions. He recognized that fear, greed, hope, and ego are the greatest enemies of a trader, capable of clouding judgment and leading to impulsive, irrational actions. He famously stated that the market is never wrong, opinions often are, emphasizing the need to respect market action above personal convictions or desires. This profound understanding meant that he would readily abandon a deeply held belief if market action contradicted it, rather than stubbornly clinging to a losing position. His ability to remain detached, objective, and disciplined in the face of market fluctuations was a critical differentiator, allowing him to execute his strategy with precision and consistency, even under immense pressure. It is this psychological mastery that truly elevated Livermore from a mere speculator to a legend, demonstrating that the mental game is as crucial, if not more so, than any technical analysis or tactical plan. For those eager to delve deeper into the intricate psychological landscape and strategic brilliance of Jesse Livermore, understanding the human element behind the charts is vital. While we discuss his tactical approaches, the true genius often lies in the mind that conceived and executed them. This is precisely why we recommend exploring a new, enhanced edition of the timeless classic, Reminiscences of a Stock Operator. This isn't just a reprint, it's a meticulously updated version that offers a profound analysis of Jesse Livermore's psychology and trading strategies, enriched with expert commentary and modern analytical insights for each chapter. It transforms his historical experiences into practical, actionable lessons for today's market participants. Imagine having the opportunity to not only read Livermore's original accounts, but also to benefit from contemporary analysis that deciphers his decisions, illuminates his thought process, and extracts universal truths applicable to current market conditions. This edition goes beyond storytelling, providing a deep dive into how Livermore thought, why he acted as he did, and what psychological traps he navigated. It offers a unique opportunity to internalize the mental discipline and strategic mindset that underpinned his success, showing you how to cultivate patience, manage fear, and maintain objectivity, all critical components of effective position management. If you're serious about mastering the psychological dimensions of trading and gaining a deeper appreciation for the mind behind the millions, this book is an indispensable resource. You'll find the link to learn more about this essential read in the description below. Applying Jesse Livermore's strategy effectively requires a practical understanding of how to translate his principles into actionable steps within one's own trading framework. The journey begins with the meticulous identification of entry points. Livermore was a keen observer of market behavior, constantly analyzing price action and volume to identify potential trends and crucial turning points. He didn't chase every fluctuation. Instead, he patiently waited for what he called pivotal points, moments when the market clearly broke out of a consolidation or confirmed a new direction with conviction. This involved extensive technical analysis, though in his era, it was primarily based on chart patterns, support and resistance levels, and volume confirmation, all interpreted through his experienced eye. For modern traders, this translates to utilizing a range of technical indicators, chart patterns, like flag patterns, head and shoulders, double, tops/bottoms, and volume analysis to confirm the strength and direction of a potential move. The goal is to enter a position not on a whim, but when there is compelling evidence that the market is beginning a sustained move in the desired direction, providing a high probability entry with a clear rationale. This initial entry, remember, would be his small test position designed to probe the market's conviction. Once an initial test position is established, the next critical phase involves the careful adjustment of position size, adhering strictly to Livermore's pyramiding methodology. The criteria for adding to a position are stringent. The market must continue to move favorably, unequivocally confirming the trend. This isn't about adding on minor pullbacks or consolidations. It's about adding when the market demonstrates renewed strength and conviction in the direction of the trade. Livermore would typically add to his position on subsequent pivotal points or clear continuations of the trend. The calculation of the size of these subsequent parts is crucial for effective risk management. As previously mentioned, each additional tranche should be smaller than the preceding one. For example, if the initial test position was 100 shares, the next addition might be 75 shares, then 50, and so on. This ensures that the average entry price remains favorable and that the overall risk exposure is managed intelligently. This gradual decreasing accumulation builds a substantial position in a strong trend while prudently distributing risk, preventing any single, larger addition from significantly skewing the average entry or exposing too much capital to a later, potentially less stable part of the trend. The art lies in balancing the desire to scale into a winning trade with the imperative to maintain a favorable risk-reward profile for the entire position. Equally vital to Livermore's success were his well-defined exit strategies. Knowing when and how to exit a position, whether profitable or losing, is often more challenging than entering. For profitable trades, Livermore advocated for allowing them to run as long as the trend remained intact. But he also recognized the importance of taking profits at appropriate times. This involved identifying target levels based on his initial market analysis, where he anticipated the trend might encounter significant resistance or begin to exhaust itself. However, he wasn't rigid. He was also a proponent of using dynamic exit mechanisms. Modern equivalents include trailing stops, which automatically adjust the stop-loss level as the price moves favorably, effectively locking in accumulated profits while still allowing for further upside participation. This method protects gains from significant reversals, ensuring that a profitable trade doesn't turn into a losing one due to complacency. For losing positions, his exit strategy was brutally simple: close them immediately when the predetermined stop-loss level is hit. There was no room for hope or negotiation with the market. Livermore understood that clinging to a losing trade is a psychological trap that can lead to catastrophic losses. His exits were always based on objective market action or predefined risk parameters, never on emotion. Whether it was taking profit at a target, trailing out of a trend, or cutting a loss, the exit was a planned, disciplined action, not a reactive impulse. Despite the clarity and effectiveness of Livermore's principles, many traders, even today, fall prey to common pitfalls that undermine their potential for success. One of the most destructive mistakes is adding to losing positions, often referred to as averaging down. This practice, born of hope and a refusal to admit being wrong, involves buying more of an asset as its price falls, in the mistaken belief that it will eventually rebound, thereby lowering the average cost. Livermore vehemently condemned this, understanding that it only compounds losses, turning a small, manageable error into a potentially catastrophic one. He preached that a loss is a signal to exit, not to double down. Another common error is the premature closing of profitable positions. Driven by fear of losing accumulated gains, many traders snatch small profits, only to watch the market continue to surge, missing out on the substantial returns that define true trading success. This cutting flowers and watering weeds mentality directly contradicts Livermore's let profits run philosophy, severely limiting the upside potential of a trading strategy. Furthermore, the disregard or constant shifting of stop losses is a frequent and perilous mistake. Traders often move their stop loss further away from the entry price when the market moves against them, hoping for a reversal. This undermines the fundamental purpose of a stop loss, which is to define and limit risk. Livermore's stops were sacred, never to be moved against the trade. Moving stops only transforms a predetermined, acceptable loss into an undefined, potentially ruinous one. Trading without a clear plan and consequently a breakdown in discipline is another widespread pitfall. Entering trades based on tips, emotions, or fleeting impulses, rather than a well-researched strategy, inevitably leads to inconsistent results and significant losses. Livermore's entire approach was built on meticulous planning, observation, and unwavering adherence to his system, highlighting that a lack of discipline is a direct path to failure. Finally, the excessive use of leverage or margin is a common trap that amplifies both potential gains and, more dangerously, potential losses. While leverage can magnify returns, it also magnifies the impact of adverse market movements, making even small errors in judgment or minor market fluctuations capable of wiping out an entire trading account. Livermore, while a master of speculation, always managed his exposure carefully, understanding that preserving capital was paramount, not chasing outsized returns through reckless leverage. Avoiding these common mistakes by internalizing Livermore's disciplined approach is crucial for any trader aspiring to long-term success. In conclusion, Jesse Livermore's strategy for position management remains a timeless testament to the enduring principles of disciplined trading. His emphasis on gradual position building through pyramiding, stringent loss management via unyielding stop losses, and the profound wisdom of allowing profitable trades to run, collectively form a robust framework for navigating the complexities of financial markets. These principles, far from being relics of a bygone era, possess universal applicability and profound relevance in today's fast-paced, technologically advanced trading environment. The core tenets of his approach, understanding market psychology, maintaining unwavering discipline, and prioritizing capital preservation, transcend specific market conditions or asset classes. Livermore's legacy teaches us that true success in trading is not about predicting every market move or chasing every fleeting opportunity, but rather about a methodical, patient, and emotionally detached execution of a well-defined strategy. By embracing a disciplined and analytical approach to position management, modern traders can harness these proven strategies to minimize risk, optimize returns, and ultimately forge their own path to long-term success in the markets, echoing the triumphs of the legendary Jesse Livermore. For those dedicated to refining their market analysis and decision-making beyond specific trading personalities, seeking a broader understanding of market mechanics and systematic approaches is invaluable. After absorbing Livermore's insights, many find themselves eager to explore other foundational methodologies. This is where how I trade and invest in stocks and bonds becomes an essential next step. This adapted edition of Richard Wyckoff's classic work offers a comprehensive exploration of his methods for analyzing market action and making informed investment and trading decisions. Wyckoff's approach, Distinct yet complementary to Livermore's in its emphasis on objective observation and disciplined execution, provides a structured framework for understanding supply and demand, market cycles, and the behavior of professional operators. It teaches you to read the tape, or in modern terms, the price and volume action, to identify opportunities and manage risk systematically. If you're looking to deepen your analytical toolkit and integrate another powerful, time-tested methodology into your trading arsenal, Wyckoff's insights are indispensable. Discover how to enhance your market understanding and decision-making process by exploring this adapted edition, available via the link in the description below.